Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden agendas behind corporate financial reports. And boy, do we have a spicy one today. Let's just say Green Dot Corporation's latest filing reads less like a quarterly update and more like its own wild ride. So, buckle up folks, because we're diving deep into Green Dot's Q3 2025 report, and we're going to figure out what these numbers truly mean for the company and for us. And hey, if you love getting these raw, unfiltered insights directly from these filings, make sure you hit that subscribe button and the notification bell so you don't miss out. We also have a fantastic community over on Discord, linked in the description below, where we break down these reports even further. Alright, let's jump right into the heart of it, the financials. Looking at their balance sheet for the 30th of September 2025, one of the first things that jumps out is their unrestricted cash and cash equivalents. It stands at a whopping $1.6 billion. That is a lot of green for Green Dot, and it is up from about $1.59 billion at the end of 2024. This tells us they've got a pretty solid cushion of readily available cash. Now, they also have a chunky amount in investment securities available for sale, worth over $2.3 billion as of the 30th of September. 2025. This is a significant increase from around $2 billion at the end of 2024. These are essentially investments they can sell if they need to turn them into cash relatively quickly. The report notes that a lot of these are government-backed securities, which are generally considered safer, but might not offer the highest returns. They also took a hit here, with a considerable unrealized loss of over $256 million as of the 30th of September 2025. The report explains this is mainly due to rising interest rates, which makes these fixed rate investments less valuable on paper. It is like owning a house with a fixed mortgage rate while market rates jump. Your house is still worth what it is, but the mortgage makes it less attractive to sell. They've decided to hold on to them though, believing they'll recover their value by maturity. Then we see their loans to bank customers, which are sitting at about $37.1 million. This is up from $31.9 million at the end of 2024. They've also set aside an allowance for potential losses on these loans, which is around $22 million. This suggests they're actively lending out money, but they're also being cautious about potential defaults. On the other side of the balance sheet, we see liabilities, and this is where things get really interesting. Their deposits are a massive $4.2 billion. This means a lot of people and businesses trust Green Dot with their money. Most of this, about $4 billion, is in non-interest bearing accounts. This is fantastic for Green Dot because they collect all the interest on that money without having to pay much, if anything, back. Overall, their total liabilities are around $4.8 billion. That is a big number, but it is important to see how it stacks up against their assets. Their total stockholders' equity is about $913 million. This represents the owner's stake in the company. So, while they have a lot of debt and obligations through deposits, their assets significantly outweigh their liabilities, which is a good sign of overall financial health. Now let's move on to how the company is actually performing in terms of making money, their operations. Card revenues and other fees are their biggest revenue stream, bringing in over $393 million for the quarter ending the 30th of September 2025. That is a significant jump of over 20% from the previous year. The report says this is largely due to growth in their B2B services, particularly their banking as a service, or BAS programs. It seems like more businesses are using Green Dot's platform to offer financial products under their own brands. Great for Green Dot, but this also means they are highly dependent on these partners. Cash processing revenues are about $33.7 million for the quarter. This is slightly down from last year. This includes services like handling cash deposits and tax refunds. Interchange revenues, which they earn when people use their cards to buy things, are about $45.3 million. This is also down a bit. They mention this is due to a drop in purchase volume and a shift in spending towards categories that generate lower interchange fees. And finally, net interest income is around $22.6 million. This is up significantly by 41%, and the report says it is due to earning more on their cash reserves and a better return on their investments. This is a positive sign, especially with rising interest rates. Now, here is where it gets a little bumpy. Even with all that revenue, their total operating expenses for the quarter were higher, at over $527 million, leading to an operating loss of about $32.8 million. That is a pretty big loss compared to a much smaller loss in the same period last year. They're spending more, and it is not translating into profit yet. This resulted in a net loss of about $30.7 million for the quarter. That is a substantial increase in their losses compared to the previous year's quarter. Looking at the bigger picture, the first 9 months of 2025 show operating revenues hitting over $1.5 billion. That is a solid 23% increase from the same period in 2024, driven largely by that B2B growth we talked about. But holding them back are operating expenses, which surged 18%, outpacing revenue growth in the 9-month period. And unfortunately, this led to a net loss of over $52 million for the first 9 months of 2025. This is a pretty significant increase in their losses from the previous year. It looks like the company is growing its top line, but its costs are growing even faster, eating into any potential profits. Now, a big reason for these increased expenses is something called restructuring and other charges. They recorded about $19.9 million for the quarter, related to their plan to exit operations in China. This is essentially the cost of winding down that part of their business. It is a one-time hit, but it definitely impacted their bottom line for this period. Then there is this other expense, net, which really exploded for the 9-month period up to $101.7 million. A huge chunk of this, over $70 million, is a one-time incentive payment related to their Walmart agreement. They're also reporting a $24.8 million realized loss from selling some investment securities. These are significant one-time events, but they highlight how much these non-operational items can sway the company's reported financials. Interestingly, they reported an income tax benefit of $12.9 million for the 9 months. This isn't because they're getting money back, but more likely due to their net loss and other tax adjustments. Their effective tax rate for the 9 months ended the 30th of September 2025 was 19.9%, a big jump from a negative rate last year. Part of this increase is due to a higher valuation, allowance on deferred tax assets and other factors. Looking at their segments, the B2B services segment is their star player, showing a segment profit of around $29.5 million for the quarter, up 6.5%. This is their growth engine right now, fueled by that Barson gross dollar volume growth we saw. But their consumer services segment is struggling. Segment revenues are down 10% for the quarter, and segment profit is down 19.5%. They're losing active accounts, and this is hurting their fee revenue. It seems like the traditional prepaid and checking account business is facing tough competition. Money movement services, which includes cash transfers and tax refunds, is pretty flat for the quarter in terms of profit, but it did see some revenue decline. Then there is corporate and other, which is a big loss, around $50.5 million for the quarter. This segment includes unallocated corporate expenses that aren't tied directly to the other segments, and it is a major drag on the company's overall profitability. Let's look at some of their key metrics to understand what is driving these numbers. Their gross dollar volume, which is the total money loaded onto their accounts, is up 18% for the quarter, reaching $39.5 billion. This is a strong indicator of overall platform usage. However, the number of active accounts is only up by a small 1.4%. This is a bit concerning. It means that while the total amount of money moving through their platform is increasing, they're not bringing in a significantly larger number of new active users. This could indicate a problem with customer acquisition or retention. Purchase volume is actually down 3.1%. This is especially noteworthy because purchase volume is directly related to interchange revenue, so a drop here directly impacts their earnings. And then there is the number of cash transfers, down nearly 10% for the quarter. This shows a decline in people using their network for physical cash transactions. Now, let's shift gears and talk about the risks. And Green Dot has a whole lot of them laid out here. First off, they're exploring strategic alternatives, which is corporate speak for we might sell the company. This process itself is risky. It can distract management, cause employees to leave, and make it hard to keep clients. If they don't find a buyer or if a deal falls through, it could really hurt their stock. Then there is the huge reliance on a single BaaS partner, which brings in a massive 67% of their revenue for the quarter. That is an insane amount of concentration. If that partner leaves or their business declines, Green Dot is in serious trouble. They also call out Walmart as a major retailer, though their direct revenue contribution is much smaller. Around 8% for the quarter. Losing these key relationships would be devastating. They're also up against tons of competition. Big banks, fintech startups, even companies like Chime are offering similar services, often for free. Green Dot is fighting on multiple fronts, and it is clear it is an uphill battle. And like any financial company today, cybersecurity is a massive concern. They're worried about data breaches, which could lead to huge fines, lawsuits, and a damaged reputation. Considering how much sensitive financial data they handle, this is a constant high-stakes risk. Speaking of lawsuits, they're involved in several. Most notably, a class action lawsuit related to past statements about their business strategy has a settlement pending. They expect to pay out $40 million for this. They're also dealing with derivative lawsuits from shareholders, which are still ongoing. These legal battles are costly and the outcomes are uncertain. And finally, being a bank holding company means they're under the watchful eye of regulators. They've had to pay a $44 million penalty related to compliance issues with the Federal Reserve. This regulatory environment is strict and can limit their ability to grow and innovate. So what is the story here? Green Dot is in a curious spot. On one hand, their B2B segment, especially their bars offerings, is showing strong growth. They're attracting more money and more businesses are using their platform. Their net interest income is also doing well, benefiting from higher interest rates. However, their core consumer business seems to be shrinking, with fewer active accounts and declining purchase volumes. This is a red flag as it suggests they're struggling to attract or keep individual customers in a competitive market. They're also facing significant cost pressures, with expenses rising faster than revenues in many areas. And they've had to absorb some hefty one-time charges like restructuring costs and legal settlements. The heavy reliance on a single BaaS partner is a massive risk, and that ongoing regulatory scrutiny could further stifle their ability to operate freely. In my opinion, Green Dot is evolving, shifting its focus towards the more scalable B2B side of the business, but the transition is painful, carrying significant costs and risks. The company's future hinges on whether they can successfully grow their B2B revenue streams and manage their expenses effectively, especially considering the ongoing consumer segment decline and regulatory hurdles. This is a company navigating a complex and challenging landscape, and the strategic alternatives they are exploring might be a sign that they are preparing for a significant change or perhaps even an acquisition. The heavy concentration of revenue from a single partner makes them particularly vulnerable, and their ability to manage this dependence will be critical. Alright, that is our deep dive into Green Dot's Q3 2025 filing. What is your take on these numbers and what they signal for the company's future? Do you think they can turn things around, or is this a sign of trouble ahead? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and don't forget to subscribe for more corporate breakdowns, and as always, check out the Discord link in the description to join the conversation. Thanks for watching, and we'll see you next time on Corporate Decoder.